In this video, I'm giving you a quick introduction to futures, how they're different from Forex, and a basic overview of prop firms. We'll cover the key differences, how futures contracts work, and what you need to know before trading with a prop firm. So what is a futures contract? A futures contract is essentially a legal agreement between two parties to buy or sell a specific asset at a predetermined price on a specified date in the future. That's the textbook definition. Now, instead of overcomplicating it, just understand this. When you trade futures, you are not buying the physical asset itself. You're trading a contract that represents that asset. If you want a deeper legal or institutional explanation, I would suggest doing your own research as well. Understanding what you're trading is important. Some common examples of futures contracts include NQ and ES, which represent NASDAQ and S&P 500 futures. You also have lean hog futures, gold futures, crude oil futures, orange juice futures. There are futures contracts for almost everything you can imagine. Now let's talk about trading hours. Futures markets run nearly 24 hours a day. They open at 6 p.m. Eastern Time on Sunday and close at 5 p.m. Eastern Time on Friday. There is no futures trading on Saturday. However, even though the market is open almost all day, liquidity and volatility vary depending on the session. That's why many traders focus on London or New York sessions specifically. If you want the exact breakdown of exchange hours for specific contracts, you can check the CME website or your broker's site. Now let's talk about platforms. There are many platforms you can trade futures on. Some examples include Schwab, E-Trade, NinjaTrader, Tradovate, AMP, TradeStation, and others. Each platform has different margin requirements, commission structures, and execution models. You need to do your own research and choose the one that fits your trading style and budget. Now here's something very important. Margin requirements. Margins vary significantly depending on the broker and the contract you're trading. There are two types of margin you need to understand: day margin and initial margin. For example, if you're trading ES futures on Schwab or TD Ameritrade, holding one ES contract overnight might require over $13,000 in margin. However, if you're day trading through a broker like NinjaTrader, the day trading margin for ES could be as low as $500. What's the difference? Day margin applies only if you open and close your position within the same session. Initial margin applies if you hold the contract overnight into the next session. Overnight margin is significantly higher. So if you want to hold positions overnight, you need much more capital. Another major advantage of futures trading is that the pattern day trader rule does not apply. If you've traded stocks before, you know that you need at least $25,000 in your account to day trade freely. Futures do not have that restriction. You can trade multiple times a day without being limited by PDT rules. Futures also have different tax treatment in the United States. They are taxed under Section 1256, which provides a blended capital gains tax rate. I won't go too deep into tax law here, but it's something worth researching. Now let's talk about leverage and contract types. Futures offer significant leverage. And unlike options, there are no Greeks like theta decay or implied volatility adjustments. Futures contracts move directly based on the underlying asset's price. There are generally two main contract sizes: minis and micros. Minis are the larger contracts. Micros are 1/10 the size of minis. For example, with NASDAQ futures, NQ, one mini contract moves $20 per point. One micro contract, MNQ, moves $2 per point. So the micro is exactly 1/10 of the mini. Now let's understand points and ticks. A point is the whole number movement to the left of the decimal. For example, if ES is trading at 4,000.25 and it moves to 4,001.25, that is a 1-point move. A tick is the smallest increment price can move to the right of the decimal. For ES, price moves in 0.25 increments, so 1 tick equals 0.25. Since 4 ticks of 0.25 equal 1 full point, there are 4 ticks in 1 point. Also, 1 point is sometimes referred to as one handle. So if someone says ES moved 10 handles, that means it moved 10 points. Now each instrument has different tick values. Even though ES, MES, NQ, and MNQ move in 0.25 increments, the dollar value per tick differs. For example, one ES tick is worth $12.50. One MES tick is worth $1.25. One NQ tick is worth $5. One MNQ tick is worth 50 cents. So if NQ moves 1 full point, that's $20 per contract. If it moves 5 points and you're holding 1 contract, that's $100. If you're holding 2 contracts, that's $200. It's simple multiplication. Points, move times dollar value per point times number of contracts. Now let's talk about contract expiration. Futures trade in quarterly contracts, March, June, September, and December. Each month has a letter code. March is H, June is M, September is U, December is Z. So if you're trading the June 2024 S&P contract, it would be ESM 24. Traders switch contracts based on volume and open interest. Usually you move to the next contract when it becomes more liquid. You can check volume and open interest on sites like barchart.com to see which contract is most actively traded. Many traders, including myself, chart the continuous contract. That automatically rolls from one contract to the next. On TradingView, there are settings like Adjust for Contract Rollover and Daily Settlement Price. Adjusting for rollover helps smooth out price gaps when contracts switch. That's the foundation of futures trading. If you truly understand contracts, margin, tick size, leverage, and rollover, you'll avoid a lot of beginner mistakes. And from there, execution becomes much easier because you actually understand what you're trading. Now you might be thinking this seems like a lot of math when it comes to calculating position size properly. You have to think about points, tick value, contract size, and number of contracts. And if you're new to futures, it can definitely feel overwhelming at first. Don't worry about it too much right now. I will make a dedicated video later explaining futures position sizing step by step, breaking down exactly how to calculate risk per trade, how to determine the correct contract size, and how to stay within your drawdown limits. Once you understand that, the math becomes very simple. For now, just understand the relationship between points, tick value, and contracts, because that's the foundation of everything in futures trading. All right, let's hop into TradingView real quick and I'll explain this properly. You can see here I have NASDAQ futures pulled up and down at the bottom it says NQ1. That means I'm charting the continuous contract. Now when you're on the continuous contract, especially on the daily time frame, there are a couple of important settings in the bottom right corner that you need to understand. The first one is Adjust for Contract Changes, sometimes called back adjustment for contract rollover. I personally have this turned on. Let me explain what that does. If I turn it off, you'll notice something happens on the chart. When contracts roll over, for example from March to June, there are price gaps that appear. That's because each quarterly contract can trade at slightly different prices due to volume shifts and forward pricing. Without adjustment, TradingView simply stitches the contracts together as they are. So when rollover happens, you'll see visible jumps or gaps in price that aren't actually real market moves. They're just contract differences. Now when I turn Adjust for Contract Changes back on, those gaps get smoothed out. TradingView adjusts the historical data so the rollover transitions look fluid. You can see here there's a rollover point, then another one. But instead of seeing large artificial jumps, the price action looks continuous and clean. That's why I personally leave that setting turned on when charting the continuous contract. It keeps the structure clean and prevents fake gaps from affecting my analysis. Now the second setting down there is settlement. I personally have settlement turned off. What settlement does is it uses the official settlement price from the exchange instead of the last traded price of the session. When you turn it on, you'll notice that some daily candles change shape. sometimes quite significantly. If I toggle it on and off, you'll see certain days where the candle bodies and wicks look very different. There are a few obvious examples where the daily close shifts enough that it could actually impact your bias. For example, a candle that looked bearish might suddenly look more neutral or slightly bullish, depending on settlement pricing. For my strategy and the way I analyze daily structure, I prefer having settlement turned off. I've found that it gives me cleaner candles and more consistent structure for my model. So to summarize my personal settings, I keep Adjust for Contract Changes turned on when using the continuous contract. And I keep Settlement turned off because it aligns better with how I read price action. Those two small settings can make a big difference in how your chart looks, especially on higher time frames. All right, let's hop back into the PDF. The next thing we need to talk about is data feed. When you trade futures, there are exchange fees required to view real-time market data. If you do not have the proper data subscription activated through your broker or platform, your chart will be delayed, usually by about 10 to 15 minutes. That delay might not sound like much, but for intraday trading, it's completely unusable. You cannot execute properly on delayed data. So you need to make sure you have the correct real-time data subscription enabled for the exchange you're trading. For example, CME data for ES and NQ. The subscription I personally use allows me to see everything in real time without delay. It's a small monthly fee, but it's necessary if you're serious about trading futures. Now, the next thing we're going to talk about is order types. This is where a lot of people get confused when switching from options or even Forex into futures. In options, if you want to short the market, you might buy a put and then later sell that put for profit. But in futures, it's much simpler. If you want to go long, you buy the contract. If you want to go short, you sell the contract. That's it. You're not buying puts or calls. You're directly buying or selling the futures contract itself. If you short the market, you sell first, and later you buy back to close the position. That's called covering. Now let's talk about the main order types. First, buy limit and sell limit. A limit order means you want to get filled at a specific price or better. If I place a buy limit below current price, I'm saying I want price to retrace down to that level and fill me there. If I place a sell limit above current price, I'm saying I want price to push up to that level and fill me there. Then we have buy stop and sell stop. A buy stop is placed above current price. When price touches that level, the order triggers and fills at market. A sell stop is placed below current price. When price reaches it, it triggers and fills at market. Now, what is a market order? A buy market or sell market order executes immediately at the best available bid or ask price. There is no specific price control. You're accepting whatever the current market is offering. Now let's talk about something very important that I personally use: OCO orders. OCO stands for one cancels the other. This is extremely useful when placing a limit entry. For example, if I place a buy limit, I can attach both a stop loss and a take profit at the same time using an OCO order. What that means is, whichever one gets hit first will automatically cancel the other. If my take profit gets hit, the stop loss is automatically canceled. If my stop loss gets hit, the take profit is automatically canceled. This makes trade management much cleaner and removes manual mistakes. Now, another common question I get is about partials. This is especially common for traders coming from Forex. In Forex, you can partial very easily. You can close 0.25 lots, 0.13 lots, whatever you want. It's very flexible. In futures, it works differently. You trade in whole contracts. There are no decimals. So if you are long 2 contracts and want to partial, you have to close 1 full contract. That's 50% of your position. If you are long 3 contracts, you could close 1 and keep 2, or close 2 and keep 1. But you cannot close half of 1 contract. Everything must be done in whole contract increments. That's one of the main differences between Forex and futures when it comes to position management. Once you understand data feeds, order types, and contract structure, the mechanical side of futures becomes very straightforward. A lot of people who are looking to move from Forex to futures get confused at this stage, especially when it comes to symbols and how everything translates. So to make it simple, I listed out the major currencies and their respective futures contracts. For example, if you're used to trading the euro in Forex as EURUSD, the equivalent futures contract is 6E. And if you want to chart the continuous contract on TradingView, you would type 6E1. Now before going further, let's compare EURUSD to 6E, so you understand the difference clearly. If we open TradingView and pull up EURUSD as a candlestick chart, and then overlay 6E, the Euro futures contract, you'll notice that the movement is very similar. However, it will not be identical. The reason is simple. EURUSD is the euro paired directly against the US dollar in the spot Forex market. 6E is the euro futures contract traded on the CME. It represents the euro itself in a standardized contract format. Because they trade in slightly different markets with different liquidity sources, you may notice small differences in price and structure. But overall, the movement is highly correlated. Many traders who come from Forex and are comfortable trading EURUSD will simply switch to trading 6E in the futures market. Another thing you can do with currency futures is use them for correlation analysis when trading Forex. Some traders like to compare currency futures positioning with spot Forex movement. If you want a dedicated video on that, let me know. Now let's talk about other common conversions from CFD or Forex instruments to futures contracts. If you're used to trading SPX 500, the futures equivalent is ES. If you trade NAS 100 or NASDAQ CFDs, the futures equivalent is NQ. If you trade gold CFDs, the futures contract is GC. If you trade oil CFDs, the futures contract is CL. So instead of trading through a Forex broker's CFD product, you're trading the centralized exchange-traded futures contract. Now, how does this differ mechanically from Forex? In Forex, you trade lots. In futures, you trade contracts. In Forex, you measure movement in pips. In futures, you measure movement in points, handles, and ticks. So you just need to understand how those measurements translate and how position sizing works under the futures structure. One of the main reasons Forex traders are attracted to futures is transparency. In futures, there is centralized exchange pricing. There is no broker-created pricing feed the way many CFD brokers operate. You also don't deal with artificial spreads the same way. In futures, there is a bid and an ask. That's it. For example, if ES is trading with a bid at 4,125.25 and an ask at 4,125.50, and you hit buy market, you will get filled at the ask. The spread is simply the difference between the bid and the ask. It's usually very tight in liquid contracts like ES and NQ. There isn't a wide variable broker spread the way you often see in Forex CFDs. So from a structural standpoint, futures offer centralized pricing, tight spreads, high liquidity, and standardized contracts. Once you understand how contracts, ticks, and points differ from lots and pips, the transition from Forex to futures becomes much easier. All right, so that's the full breakdown of futures. From what a futures contract actually is, to margin, ticks, and points, rollover, data feeds, order types, and how to transition from Forex to futures. If you're coming from Forex, just understand that the concepts are not completely different. The structure is just different. Instead of lots, you have contracts. Instead of pips, you have points and ticks. Instead of broker pricing, you're trading on a centralized exchange. Once you understand that foundation, everything becomes much simpler. Don't rush the process. Take the time to understand how contracts work, how margin works, and how position sizing works. I'll be making a separate video specifically on futures position sizing to break that down step by step. If this helped you out, make sure to like, share, and subscribe. If you want to connect with me, join the Telegram and Discord. Links are in the description. And if you want to learn personally from me, check out the mentorship link below. I've also added funded account discount codes there for you. Trade smart, stay disciplined, and I'll see you in the next one.